Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. What a week. Woo! Therefore, what a show. I am pleased to announce, as promised in our previous podcast, we're bringing in the big guns to talk about the big, beautiful bill, and in particular, the Trump accounts. Nelson Hunt, estate attorney extraordinaire. We've got him on an interview. So it's going to be wonderful. We also delve into some of my favorite topics. Jason Zwig is going to talk about concentration risk in a Wall Street Journal article. It is excellent, and the historical data in this article was a great encouragement to me. We then delve into private equity and various endowment funds' relationship with private equity. But let's start at the top with Mr. Nelson Hunt. You're going to enjoy this interview. Nelson Hunt, thank you for once again answering the bell. We issued this command that the finest estate attorney in the land come, and only one made it through. And that's the person that we're talking to right now. How are you today, Nelson?
Good, thanks, Robert. Glad to be here by phone. Thank you.
I know. It's our first by phone. I hope the listener, I did a test today and the audio sounded pretty good. It sounded so good. I don't know that the listener is going to be able to tell because this fancy dancy AI thing hopefully clears up the audio quality too. But we're back for these Trump accounts. So Mr. Hunt, as you'll recall, you on your latest interview, you gave a broad brush of all the various options that were available, but you mentioned these Trump accounts. And as you or I were having a casual conversation, I was mentioning some of these rules, and just by way of review for the listener, you can go online to open these accounts up, where you talk to your CPA or your TurboTax and fill out a form, and it will trigger the opening of the account. But when I mentioned this, you were sitting to my right, and I said, "This is great. I'll just tell people that I served. I'll consider this for myself. We'll just give money to these accounts that ultimately become traditional IRAs, but not until they're 18. And isn't this a great deal? And this will use up my annual exclusion amount, but I won't have to even think about my lifetime exemption amount." Walk me through this. What is a nuance that potentially the Treasury, potentially the government missed here in these accounts?
Well, the nuance is that a contribution from a parent to a child's Trump account is probably not a gift of a present interest, which means that it does not qualify as an annual exclusion gift. And the result there would be a contribution uses up some of the parent donor's lifetime gift tax exclusion amount and requires the parent to file a gift tax return to report that contribution.
That's disgusting. The idea that a parent is going to file, let's say I give $500. Let's say I give $250 to this account. Are you telling me that I'm going to be required? Now, I think you're ahead of the curve here, Mr. Hunt, but is it possible I'm going to have to be required for $250 gift to these accounts to file a gift tax return?
Yes, that is what the law currently says. But I'm going to add to that my guess would be that either Congress or Treasury fixes this sometime in the next few months. Because as I was thinking about this after you and I talked, and I went and I looked at trumpaccounts.gov, I looked at some other materials out there. It seems clear that the government intended gifts to these accounts to qualify as annual exclusion gifts. And I mean that just the whole tenor of the way that trumpaccounts.gov sells, the benefits of these accounts and other things you see online, it all seems to be along the lines of, this is something that everybody can use and it's easy, and you're setting up your children for success by making these gifts to them. It would be shocking if behind all that, Congress actually intended for people to be filing gift tax returns and using their lifetime exclusion to make contributions. So I would expect some guidance uh, to come out between now and July 4th that clarifies that these actually do qualify for the $19,000 per year annual exclusion. But again, under current law, that is not the case.
Wow. Well, I certainly hope you're right. And I had an idea that I suspect no one should, take action on, which is you just give the money to your kid and their checking account and the kid gives the money. I think you're right, though. I think the intent of these programs is not to create complexity. Although with as many lawyers as we have in Congress, Mr. Hunt, it makes you wonder, is this the Full Employment Act for lawyers and accountants? I have my suspicions that behind every government edict there is this desire for complexity. So, well, Nelson, that is exactly the type of intel we needed. I had never heard of this, and so when I was just boisterously saying, "Oh, this is great," I didn't consider what you know, which is that there are rules behind rules behind rules and layers. So,
Yeah.
yeah, it's good to
Well,
know.
and
And
it's not just me. So there's other commentators that have noted this, and so it's kind of hard to find. But if you look around, there's it's clear that people have noticed this issue, and that's why I think Congress or Treasury will do something to fix it.
is it your advice then? We're not holding it to you, okay? But that people could probably just proceed as if it will be fixed, or do you think it's
No,
wise to wait for
yeah,
it?
I would not proceed to. Again, like I think there will probably be a fix in the next few months, but I would not recommend making a contribution
Mhm.
until there's some written guidance from the IRS or until Congress updates the law to make clear that these qualify for the annual exclusion.
Thank you, Mr. Hunt. We will proceed as you have advised. It is no surprise to us that you caution us to be wise, especially on a podcast. Yeah, that guy Nelson Hunt told us we were good to go. Yeah. So anyway,
Yeah.
we received this advice and are grateful for it. Anything else you'd like to add? Anything else on your heart in the legal sphere that you feel must be told to the masses before we sign off today?
Well, I would just maybe you've covered this maybe we covered this in our prior podcast, but just keep in mind that there are lots of other ways to use your annual exclusion. So
Mm.
it's not like, you have to use it on an account like this. So
Mm.
there's UTMA accounts for children, there's
Mhm.
educational savings accounts. Uh, there are trusts that you can create that work for this purpose. So um, this is not the only game in town. It didn't exist as a game in town until this
Mm.
year, and so there are other ways to benefit your children without using a Trump account.
Well said. Thank you. Well, we appreciate it, Mr. Hunt, and we look forward to having you. I feel like Mr. Rogers, and you're one of our friends in the neighborhood. So just know that, it's a wonderful day in the Robert Hunt Financial Market Update neighborhood, and we hope you'll be our neighbor again.
Of course, I'm always happy to be a neighbor, and thanks for having me on this time.
Okay, we will talk to you soon. Bye bye. Nelson Hunt, wonderful. Let's talk Jason Zwig and concentration risk. Doubtless, you've heard it said, and I know I've brought it up on this podcast before, little top heavy, guys. Don't you think the S&P 500 is just a little top heavy? And when they say that, they mean the holdings, the largest holdings in these indices are too big. It's too much. Too much. And there's risk. Ooh, it's so scary. This headline, The Big Scary Myth Stalking the Stock Market. Subheadline, having 33% of your portfolio in 7 companies is less risky than it sounds, because it's true. Zwig is just one of our heroes. So he starts with a great story here. If you remember Back to the Future, he says, if you could have a time machine like Doc Brown's DeLorean that could transport you to the best possible time in history to invest, you know where you'd go? He says he doesn't know about us, but June 1 of 1932. Now, the historians will know what that means. That was the bottom from the Great Depression's crash of the stock market. The S&P had fallen 86.2% from its peak in 1929. Now, that data is going to matter, okay? I'll say it again. On that date, June 1 of 1932, the S&P 500 had fallen 86.2% from its peak. Is the stock market fun? Are we having fun yet? You want more equity exposure? Whew. That's tough. In fact, actually, we're going to talk about this next week because time doesn't allow this week. But next week, we're going to talk about equity exposure. It's a great article sent by a friend of the show that I want to delve into. But guess what? If you had invested at the bottom, June 1, 1932, you would have had annualized returns, the highest ever recorded, 12.3%, 15.1%, and 16.1% over the ensuing 10, 20, and 25 years. A 16.1% annualized return over 25 years would turn $100,000 into $4.2 million. Wow. But what? It would have been dangerous. It would have been dangerous. Why would it have been dangerous? It was concentrated. On June 1, 1932, guess what? 12.7% of the value of the entire stock market was one company, AT&T. That's right, AT&T. They've been around a long time, jacking up your internet bills and cramming fees into your cell phone plans since at least 1932. They've been doing it a long time. Well, guess what? That's more than today's biggest stock, NVIDIA, which accounts for 7.8% of the market value. So you see, isn't this history helpful? But here we go. Zwig is so right. A lot of financial advisors, these are my people, and asset managers are saying these things. The S&P 500 is excessively concentrated. It presents elevated risk to investors. It's broken. It's not safe. They try to use formal register when they say these things to sound particularly astute. Don't take the bait. You don't need it. Zwig is right on. A lot of the industry is designed to make you frenetic and enter into activity that does not help you but helps them. And Zwig hits the nail on the head. Oh, yeah, you need to hire them to dodge. This is the article. You need to hire them to dodge tactically in and out of markets, pick stocks or funds for you, or get access to non-traded assets like private equity funds that will supposedly shelter you from the scary concentration market. I use the word scary, just from this concentration market. So Zwig is just so right on. Investors need to be wary of messages about markets that are really about marketing. Ding, ding, ding. It's just the truth. And here's this long list of problems with index funds. In the 1970s and 80s, tracking the market with low-cost index funds, instead of hiring an expensive stock picker, was settling for average. These are folks who didn't study statistics, but they were settling for average. Of course, they went on to beat all the active funds. In the 1990s, brokers called index funds tax bombs that would hit investors one day with a huge bill. Didn't happen. Then they warned you that index funds, they would never protect you from market crashes. Well, neither did the active funds. And most recently, stock pickers touted their unique abilities to pick socially minded companies. Didn't work out. So now concentration risk is the new boogeyman. They're trying to get you off point here. You don't have to take the bait. So Zwig talks about all these big companies, the total return, and it's fine. It's perfectly fine. You do not need to run from this concentration risk. In fact, the data doesn't support it. So Mark Kritzman, chief executive of Wyndham Capital Management, he says taking risk off the table every time the market gets more concentrated would have been very harmful historically. He says it may help you avoid some fraction of the sell-offs, but you incur a huge opportunity cost in losing out on the run-ups. Ding, ding, ding. So he said if you had done this to try to not be so top-heavy, you would have earned an annualized average of 0.9 percentage points less than if you simply bought and held. Isn't that the moral of basically every story? Yeah, if you had bought and held, you would have been better. But what about the late nights trying to de-risk yourself? Ugh. Goodness me. So don't worry about it. Don't worry about it. By going the simple route, the tried and true simple route, owning the index, these large stocks are just fine. Don't take the bait. And I thought in closing they did a great job. Active managers are very good narrative creators, says Atwill, the former Russell and Parametric executive. The industry has had a lot of time to practice all these effective narratives to make people feel the managers possess this magic. That's the Wizard of Oz. Everyone wants to see the wonderful Wizard of Oz. They have this magic. Only they know. Only the industry. You don't you dare try to learn yourself. Aren't we glad for the printing press? We can now read for ourselves and learn for ourselves. And then we move on to one of my favorite topics, private equity. And the Ivies are having second thoughts about investing in private equity. Headline. Well, that's the headline. Subheadline: a crowded field and subpar returns have frustrated America's wealthiest universities, some of private capital firms' most loyal clients. So, Princeton University lowered its projected endowment return to 8% from 10.2. Yale trimmed its leveraged buyout portfolio to $9 billion-ish from 10.7. Private equity returns of 7.4% annualized over 3 years trailed the S&P 500's 19.7 over the same period. I'll say that again. If you were Mr. Private Equity, you sorted through all your returns, you got the right people, you earned 7.4%. Whereas if you had just been fuddy-duddy S&P 500, 19.7. Now, I'll confess, that is a scorching hot return for the S&P 500. But you didn't have to do anything. Now, you rarely hear this. This sentence starts, Princeton University is lowering expectations. What? Princeton would never do that. A lot of friends of the show went to Princeton. We love Princeton. Thank you, Princeton. But it is lowering expectations for its endowment funds because private capital investments have disappointed. So this relationship has historically been a pretty good one. Mr. Swinson, who's passed away, really he was the Yale endowment chief and really developed modern endowment theory. He led the charge in these private assets, but under very strict rules that he recommended others not try to replicate. He has a great quote about index fund being the best investment you can make. Don't you worry. I looked at some of these, and there are other periods, believe it or else, where private equity, as measured by these folks, actually kept pace with index funds. So what has happened? Well, this article points to interest rates being a big driver of returns for private equity. In a lowering interest rate environment, the way a lot of private equity funds work is they're borrowing money inexpensively, they're buying companies, and they're flipping out of them. So it's a use of leverage that results in a positive result in a lowering interest rate environment. It really helps. Well, guess what? Interest rates didn't go down the last 3 years. So it made their world tough. Listen to these annualized returns for the fiscal years 2022 to 2025. Princeton, 2.8%. I'll say that again. Annualized returns. This is Princeton. Now, it's not Texas A&M, but it is a fine place with a lot of hardworking people who are doing their best. 2.8%. I mean, guys, that's not just kind of bad. That's bad. MIT, again, a lot of hardworking folks, 3.5%. These are annualized returns of the last 3 years. Guys, if they had put it in that S&P 500, they would have just done it. Now, Cornell, ever heard of it, did the best of this list at 5.7%. So it really highlights just how tough a world. And if I could just be a fly on the wall at those meetings, can you imagine the pain? You're meeting every month. All right, Larry, how's the private equity portfolio that we spent years and 80 analysts, and how many dinners did we go to, and how many Knicks games did we get floor seats to? Those are the most expensive floor seats to the Knicks games they've ever been to. And these are endowment sizes that are monstrous. Monstrous. Princeton's got a $36 billion endowment, Yale 44, Harvard 57. If they were to hire me, and I'm here, we would, you know what we'd do. I bet you do. We'd keep our cost low, our investing simple, and our time horizon long, because that is what's going to give these endowments and you and me the best shot on our investing journey. Until next week.